The global financial landscape is constantly evolving, and recent developments have sparked significant interest among the investors and the market participants. Today, we will dwell into several key topics, the S&P 500 reaching all-time highs, then discuss the implication of Trump's policies and the ongoing discussions at the Davos event. Lastly, we'll talk about the Bank of Japan's interest rate hike. So without any further ado, let's begin. The Standard & Poor's 500, or rather S&P 500, is a stock market index tracking the stock performance of 500 of the largest companies listed in the United States. Like how we have Nifty 50 and Sensex 30, the US has S&P 500 and nasdaq 100. Now the S&P 500 recently surged to an all-time high, crossing the 6,100 levels, reaching a 52-week high of 6,118 points. And if we compare the performance with Nifty over a 3-month basis, S&P 500 has delivered 5.3% returns, while the Nifty has delivered negative returns of 3.6% over the 3-month period. But why has the S&P hit all-time highs? One of the primary drivers behind the rally has been the robust corporate earnings and easing inflation concerns. Companies in the US have been reporting impressive fourth quarter results, with many exceeding analysts' expectations. For instance, tech giants like Netflix and Oracle have seen their stocks surge due to stellar earnings reports. This reflects robust economic activity and business growth. Additionally, US inflation picked up last month to 2.9% as prices rose for gas, eggs, and used cars. However, the underlying price pressures showed signs of easing. With Trump coming to power, analysts and investors were worried about the inflationary impact of policies promised by Mr. Trump. In particular, new tariffs and a mass deportation program that could push up consumer prices and wages. As mentioned, the underlying price pressures have shown signs of easing. Nevertheless, the Fed Reserve will have a wait-and-watch approach in the upcoming meeting on January 29th and may look to initiate rate cuts in March. Now moving on to Trump, who has sworn in as the 47th President of the United States, and since taking office, Trump has enacted numerous executive orders that have shaped both domestic and international policies. Here are some key actions. First, Trump declared a national emergency at US-Mexico border, reinstating strict border controls and ending birthright citizenship. Second, he introduced a 25% tariff on goods from Canada and Mexico and 10% tariffs on China. Next, Trump pulled the US out of Paris Climate Agreement again and announced plans to expand fossil fuel production, particularly in Alaska. Next, he withdrew the US from WHO and suspended foreign aid for 90 days. His focus remains on America First, limiting global engagement. Lastly, Trump raised concerns about a 100% tariff on BRICS nations, including India, on discussions about de-dollarization. BRICS, which includes Brazil, Russia, India, China, South Africa, and others, is the only major international group that the US is not a part of. Now, what could be the impact on India after Trump 2.0? As Trump settles into his second term, his policies are creating ripples across the globe, and India is no exception. With Trump's America First approach, India is facing both challenges and opportunities as the US redefines its role on the world stage. Firstly, Trump's return has created market volatility, reflecting concerns about his policies on trade, geopolitics, and the economy. Next is the H-1B visa policies. Stricter visa norms could hurt Indian IT firms, while relaxed policies may benefit them. Next is a tough stance on China may strengthen US-India ties, boosting sectors like IT, defense, and manufacturing. A stronger US dollar could pressure the rupee and lead to foreign outflows, while a weaker dollar might aid FPI inflows. Pro-fossil fuel policies may stabilize oil prices, benefiting India as an importer. But all in all, investors should focus on India's domestic fundamentals to navigate the potential volatility under Trump's unpredictable governance. Now, coming to our last development, the Bank of Japan's interest rate hike. Its benchmark interest rate by 25 basis points to 0.5%, marking its highest level since 2008. This decision comes with rising inflation concerns, with Japan's core inflation hitting a 16-month high. Why is the rate hike in Japan so significant, you may ask? Now, let me explain this. Since Japan had kept interest rates nil or very low, it had given investors the opportunity to borrow and invest in overseas markets like US, European markets, and Indian markets, where interest rates are higher. Now, with the Bank of Japan hiking rates, it has caused a lot of pain to forex traders employing this strategy, causing a further disturbance in the global markets. While the direct impact on India may be limited, the Bank of Japan's move could have indirect consequences through global market movements and shifts in capital flows. Now, to conclude, the recent surge of the S&P 500 to an all-time high reflects a confluence of strong corporate earnings, easing inflation concerns, and supportive economic policies from the Trump administration. In addition, implications of the Bank of Japan's interest rate hike are also noteworthy, particularly for emerging markets like India. Together, these developments display the interconnectedness of global economies and the importance of staying informed as we navigate this dynamic financial landscape. Having said this is Neha signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.